name is Mary Pearl Opare Ado, and I'm your course tutor for corporate financial analysis. Welcome to Unit 2, where we'll be studying the statement of shareholders' equity as well as the statement of cash flow. In this session, we'll be dealing with the statement of changes in equity in terms of reformulation and elements that make up this statement. This session, you should be able to understand what a statement of changes in equity is, explain the elements of the statement, undertake reformulation, and also perform analysis of the statement of changes in equity. So according to IAS 1, the statement of changes in equity is one of the main statements that should be included in an annual report. In our previous unit, we studied about annual reports. We mentioned that they include both financial statements and non-financial statements. Now, the statement of changes in equity is one of the financial statements that should be included. Now, this statement simply tells how capital that has been invested in the business has been used over a period of time. So, there are shareholders who are part owners of the company. In other words, they have shares in the company. They invested an amount of money which is equivalent to the number of shares that they hold. Now, these shareholders are particularly people who have provided funds or have invested funds into the business that is used for the operations of the business. Now, you would want to know how these funds that has been invested into the business has been used over the period of time. So it's the changes or the statements of changes in equity that reflect all transactions or all effects or balances that has taken place within that period. And it gives an overview of the capital position of the company, what other reserves is composed of, and also what the company uses its earnings for. So why is it necessary to reformulate the statements of changes in equity? Earlier, we made mention that financial statements are prepared using generalized concepts and conventions. Now, in order for you to make meaning out of this general statement that has been provided, it's necessary for you to reclassify and reorganize specific items in the statement in order to depict various aspects that you want to clearly understand. So this reformulation is done in order to highlight very important information in the statement and make it easier for you to read and understand, and also help you in case you have to make any kind of financial or investment decisions. So earlier, or a few minutes ago, we mentioned that the statement of changes in equity reflects all transactions that affect shareholders' equity. These are the steps in order to reformulate the statement. Now you get the beginning shareholders' equity balance for the period, and shareholders' balance excluding preference shareholders, because we are dealing with equity shareholders. And now you record every transaction that has occurred with shareholders. And these transactions could be either you have paid dividends to shareholders, or there's been any share repurchase, any proceeds you've made from issuing equity shares. You record these transactions, and then you find the total income that is available to shareholders, to equity shareholders to be specific. So if there are any proceeds or if there's any foreign exchange income that was obtained by the firm, you include all that, and then you calculate the ending shareholders balance. Analysis of the statement of changes in equity. So an equity analyst is somebody who studies and analyzes financial information and trends for an organization or industry. So there are people who specialize in equity analysis, and this is because people have several investments they would want to make in companies, and you wouldn't want to invest in a company and not know what your capital is being used for, and you'd want to know if you are actually getting returns or your capital is actually diminishing. So the statement of changes in equity provides a summary of all transactions that affect shareholders' equity, and it also reconciles the beginning and ending balance of equity. Three key elements of the statement of shareholders' equity, and they are the share capital, other reserved, and retained earnings. Now we'll discuss these three items into details. Now the share capital is the total amount of money that has been invested into the company by its shareholders for use in the business. Like we made mention, there are when you take the capital structure of a firm, they are usually either they are all equity or they are all debt, or the firm employs both equity and debt in specific ratios. Now, the share capital has to do with the equity aspect of the firm, of the firm's capital structure. So, all the total or the sum of money that has been invested by all the shareholders of the company in order to use to run the business. That is what share capital is. Now, other reserves of the company are dependent on the business activities, and they also include revaluation reserve and foreign exchange reserve. So, depending on what activity or what business the firm is engaged in, you'd have several reserves. Okay, so if you're a firm that has or that deals in foreign exchange transactions a lot, you may have foreign exchange reserves, or if the firm has a lot of assets, as and when assets are being revalued, then the firm might have reserves as well. Now, retained earnings is the third element, and it refers to that part or that percentage of net earnings or net income that is not paid out as dividend to shareholders, but then it is retained by the company to be reinvested into the core activities of the business, or they may also be used to settle debts that the firm has. So if the firm has been making profits over a number of years and they do not pay all those returns to shareholders as dividend, but rather they keep some and reinvest in the firm, then those funds or that part of the earnings that is not paid out but is kept in the business is known as retained earnings. So why is the statement of shareholders equity Why is the statement of shareholders equity important, or what's the relevance of the statement of shareholders equity? First of all, it shows the movement within equity accounts over the period, and also in cases of financial difficulties, a company or a business with strong capital position is able to survive more than one with a weaker standing in terms of existing equity. So from the basic accounting equation, we know that assets is equal to capital plus liabilities, and capital is the amount that has been invested into the business by the shareholders, and liabilities are any external obligations or debts that the company has, and those the sum of these two refers to the assets of the company. That's any item that from which future economic benefits are expected to flow into the company. Now you would realize that, for example, with the banking sector in Ghana, when there was a recent cleanup, that the capital or the minimum capital requirements had to be adjusted upwards. Banks who had really good capital position were able to survive because they were able to raise enough funds to meet the regulatory requirements, and those who didn't have strong capital position were either consolidated, or those who couldn't stand the test of time eventually had their licenses revoked. So this is how important the statement of shareholders equity is. It comprises, like we mentioned, the share capital, other reserves, and retained earnings, and it can be a source of cushion to the firm in times of distress, or when they are having financial difficulties. The firm has something to fall back on. Comprehensive income reporting. When we say comprehensive income, we are trying to measure the total amount of all operating and financial events that have changed the value of an owner's interest in a business. So it's usually measured on a per share basis to capture the effect of dilution and options. Now, total comprehensive income is the change in equity during a period resulting from transactions and other events other than those changes resulting from transactions with owners in their capacity as owners. By this, we are trying to say that any item or transaction or that affects or that is a component of the profit or loss account or other comprehensive income is what we attempt to measure as comprehensive income. So, for example, if there's a revaluation of assets and they have surpluses, that is a transaction or event that has nothing to do with the amount of money that has been invested by shareholders or the amount of share capital of the business. Therefore, it is a comprehensive income and therefore will be accounted for. These are some of the components of other comprehensive income. One, changes in revaluation surplus, actual gains and losses on defined benefit plans, also gains and losses that arise from the translation of financial statements of a foreign operation, also gains and losses that arise from remeasuring a financial asset that is available for sale, and also effective portion of gains and losses on hedging instruments in a cash flow hedge are all components of other comprehensive income. Comprehensive income can be reported in several ways, and these are the three main ways that you can report comprehensive income. First of all, you can report comprehensive income in the statement of shareholders' equity, and you can do that by adding net income to other comprehensive income items, and you report it in the statement of equity. Or you can add other comprehensive income to net income in the income statement, and then finally you can close the total comprehensive income to shareholders' equity. Or better still, you can present or prepare separate statements of comprehensive income aside the income statement, and then you close it to equity along with the net income from the income statement. In this session, we understood what a statement of changes in equity is. We explained the three main elements of the statements of changes in equity, which are the share capital, the other reserves, and retained earnings. Also, we undertook a reformulation of the statements of changes in equity for analysis, and we also outlined the components of comprehensive income. Thank you.